Basic traders focus on market structure. Basic traders focus on support and resistance. Basic traders focus on Fibonacci, EMAs, and all of those things. But on this channel, we spoke about more advanced situations and in fact, more real situations, because the reality is the market is not crystal clear, perfectly waiting for your EMA tap. So in these advanced situations is where profitable traders are found. And in today's case study, what I want to show you is what to do when you have a market structure scenario that is a bearish market, but price is going bearish and tapping into a major demand area, and at the same time tapping into that supply area right above, the last lower high that made the lower low. When price is locked like this, when price has reached the supply zone and price has reached the demand zone, market structure is neutralized. Fibonacci is pretty useless. EMAs can be a guide, but the reality is you need clarity in these nuanced, real situations. And what do we say? Liquidity is king. So many times in my videos, you've seen the importance of M1 trading, how paramount liquidity can be because it's the fuel and essence of the markets. Pretty much all of 2024, I've been giving my trades live ahead of time, entry, stop loss, take profit level, and everything in between before the trade is played out. And you can see how M1 trading and liquidity supersedes market structure, smart money concepts, and any indicator you can imagine. So therefore, we want to come back to core principles. The proof is there. You've seen the track record. You've seen the broker sync journal. You've seen the live call outs. You've seen everything you need to see. So in this video, I want to bring your attention with data-driven proof, a strategy that has a proven mechanical edge, how I'm utilizing these concepts in market scenarios that can be a little bit more complicated, which is probably where your losses are coming from. And if you can start to implement these things, I'm sure you will have better wins, less losses, and therefore overall more profitability. And think what that can do for you if you have better metrics going into your funded account. So imagine you're in this scenario, which happens all the time in the markets. I call them inflection points, where two examples arrive to the same point and you have two equally valid outcomes. For example, if you arrive to a supply zone, well, sells are more favorable. That is not an inflection point. You arrive to a demand area, buys are more probable, and therefore that is not an inflection point. But there are certain cases in the market where price arrives and both buys and sells are both equally as probable. These inflection points are where people get it wrong, because either you don't trade these areas and people falsely trade sells or buys in these areas, or you wait for exact confirmation types to know in this inflection point which one is actually more probable. And this navigation process is exactly what we're going to do. So imagine you have higher time frame long-term bullish like this, and therefore you're going to mark out your demand areas, and therefore you can imagine a higher low that made a higher high, that is an associated demand area. Let's say this is a historic price, maybe a couple months ago, and now you see price starts to do a retracement, a complex pullback, comes to the first demand area, starts to fail. So now you know you are in a complex pullback, a bearish market, and we need to establish, is this overall a bearish trend to make new lower lows, or is price simply breaking this previous demand area because sellers are in control to come to this next demand area and react like this from this area? That's what we need to establish. So what happens in a scenario where market is clearly bearish at the moment? We can see these lower highs and lower lows in red, but then price arrives to a demand area. So in this scenario, you have two things that can happen. Because you have an associated demand and supply area, price can come to this supply area and go on to make lower lows, and therefore I'm going to do that in a red because that is the bearish narrative, and that would completely make sense if that happened. However, at the same time, we have a read where price could continue on bullish and make a higher high like so. Why could this potential outcome happen? Because we came to a demand area that made a higher high previously, price returned to this area, going on to make a new higher high. This is just bullish trend off the back of this demand area. However, we still have this internal bearish trend. It had a higher time frame break of structure. The last higher low that made the higher high was being taken out and bearish price action. And then we arrived to a supply zone and then continued lower. So these are the zones that no one speaks about. These are the zones that actually people take losses, because you can come into this area and think it's a supply zone, I need to sell. Or you come into this area and say it's a demand area, I need to buy. Well, there's completely different outcomes, bullish or bearish, derived from these same areas. So if you're not well prepared to navigate these areas, how are you going to trade? Let's say you're a swing trader and you want to trade these higher time frame zones. If you don't know that the bearish narrative is taking control, you'll take a loss. Or if you are someone that is trading intra-session, you're trading this internal trend and you're bearish, the price is coming to a demand. Let's say you don't take a loss on the sell. You need to know how to trade one or the other, and you need to also know when not to trade one or the other. This is important because these things happen all the time. This is a very isolated example, but the fact that price is doing a multi-time frame read, market structure is giving two perspective outcomes, and both of them seem valid, what do you do then? This is where this video is going to make sense to you, and this is where you're going to find a better win rate, because you're getting clarity in your market structure. And how are you finding that? Time, liquidity, low time frame confirmations. The three things that I always mention as non-negotiables that you should index for and prioritize in any trading strategy that you may have. So here we have an example of just that. We had a bullish market with high, higher low, low, higher high, bullish trend, and the last demand area, the last higher low that made the overall higher high is that demand area right here. Now this is on a higher time frame, this is the daily time frame. I've refined it down to a lower time frame zone on M15, but the natural thought process can be that even though we have bearish price action leading into that demand area, we can start to think, because we are in that demand area, this is a higher low that made this bullish trend higher high, we should expect to continue and make a higher high, which is completely valid. But what we do know is not every demand area is respected, and just because it's a higher time frame demand area doesn't mean it has to respect. In fact, major inducements, one of the best things I like to trade, higher time frame runs of liquidity and major inducements, these are the best things. So we know that these demand areas can also be taken out, swept for their liquidity, because how many people see that demand area? Pretty much everyone. It's the most obvious zone on a daily time frame, a demand area that made a higher high. The whole world is looking at this. So if everybody can see it, everybody can trade it, everybody's stop losses are there too. So getting a sweep of that is a likely thing. So we need to be aware that the bearish price action leading into it could be temporarily in control. So we need to know, is the bearish market in control and is going to switch and make a lower low? Is it going to be a temporary bearish market to simply sweep this liquidity and we can actually find a valid sell opportunity to sell into a lower low? Or is it going to be a run of liquidity to go on to make a higher high? Or is it going to be respecting the zone and simply making a higher high and therefore any sells being validated? When you are at these zones, multiple things can happen, most of them being valid, and we need to differentiate between all of them. And the only way you can do that is lower time frame. The only way you can do that is inducements, because you can have bearish market structure and buyers be in control. Think about that. How can you have bearish market structure and buyers be in control? Because inducements take priority over market structure. You can have a smart money candle, a order block that swept liquidity that fails. Why is that? Because inducements run the show. So liquidity will always be number one. And in this example, I want to show you exactly this. So for now, demand area on a higher time frame, we identified it and we reduced it down to an M15. How did I do so? That higher time frame daily zone, I simply brought it down to an M15. I identified this refined IFC. It's an important one because not only is it the one that had a strong reaction out of it, more importantly, we had liquidity build up over here and an inducement with volatility, with reaction. We can see that by the imbalances, and we can see how this completely took off and made the high high. So this zone is the extreme of that point of interest and is refined down to this zone. Not only a refined IFC with an imbalance and momentum, it's about 15 pips, which is ideal for a point of interest. So what we see is that refined demand area price on M15 has actually tapped into it. So we've tapped into that demand area, but we also have the bearish price action, and the bearish price action is quite important. But all of this can be summarized as a very clear trend line where we can see the first touch, the second touch, a few more third and fourth and fifth touches, and a sixth touch, a very clear trend line. And then we had a sweep. So this sweep was obviously seen as a breakout by some. So people are doing the break, retest, continuation theory. So not only did we take out stop losses of this whole zone and also the whole trend line as a whole, we took out sellers. We also invited in buyers into the market because they were seeing the break, test, buy, and continuation. So that was a clear liquidity event. And why is that liquidity event important? Is because not only is it a clear inducement, it's an inducement that led to a lower low. So we have two very powerful things happening right now. Number one is we had this inducement. That inducement is not only making a lower low on this time frame, it was time relevant, swept important liquidity, had manipulations on a daily cycle with Asia range, which I won't get into now. But lastly, it led to a lower low. This whole area of support with one touch, two touch, three touch, this whole range, this was the reason that we broke out of that range. When we could see price was clearly consolidating within this area, this inducement allowed price to come lower. Now, when price did come lower, we tapped into that higher time frame daily demand, refined down to the M15 refined IFC. So now we are locked between two zones. We are locked between this inducement high and this tap into demand low. So what should happen next? When we are locked between demand and supply, we need to see who's in control because market structure is slightly neutralized. We need to first identify preemptively who's in control, because if M5, M15 starts to go bullish, then it's easy because we have the daily time frame bullish and we're in that daily demand area, and then M5, M15 is also bullish, intra-session, intraday is bullish, so we just look for buys. There's no doubt there. But when intra-session, intraday is bearish, but daily is in a demand area bullish, that's a bit of a clash. And how many times does that happen in your trading when you are seeing two things based on different time frames? A lot of people say stick to the higher time frame because higher time frame is more important. And although that can be true, it's not an absolute truth because the lower time frame is more in touch with what's happening today, with the control of today, with the news events and liquidity of today. We need to read the intra-session time frames because those are the first dominoes that fall to allow the higher time frame to play. As we know, the market is fractal and each swing trade, each daily trend starts with the M1 break of structure. So we need to read these things and connect the dots. So first of all, the bearish market structure we can see is the last lower high that was an inducement to go on to make this lower low and then lower high. But this area fails to make a lower low because we are supported by this demand area that we mitigated. So this is where changes start to come. So I'm going to mark this out and say this area was the area that failed to make a lower low, but it does not go on to make a higher high on this time frame. So we are in between this range. And when I see that price is respecting the last supply, the lower high that made the lower low on this relative push, price is respecting this area right here. So when it's respecting it, what do we see price does? We quickly do a minor inducement. What does that mean? We sweep the liquidity right here. We have this small inducement right here, and that small inducement enables price that slightly made this lower low to go on to make this internal higher high. And then we have this higher low, higher high, but we have to see it again. And we say, oh, there was liquidity that was in this area that we can clearly see there's a few touches here, and then we got another inducement. So then we can start to see that the buyers are actually in control, because not only we hit a higher time frame demand area, the daily demand, which we can refine to this area, we saw an inducement and another inducement. The dominoes are falling, the dominoes of control. Now that's all well and good. We can look to buy. Then we start to hit this supply area, the last inducement supply zone that made the lower low into this demand area. Price has returned to it. So the complex pullback can be considered complete because, as you know, markets move like this. We have a bearish impulse down, bullish internal price action until we reach the supply, and then we could make a new lower low. So that same thing can be happening right here. Lower low, internal bullish, and then make a new lower low. So we need to see that happening and potentially consider this supply zone that made this internal lower low could go on to make a lower high and a new lower low. So this new bearish trend that's happening right here could also be broken into bearish price action like so. So this could be a mirror like this. We have bearish price action going on like this. So when we are a little bit confused because we have a bearish supply zone, but we have a bullish demand area, we are in between. We can see the buyers are in control from these inducements, but we are left with not full clarity. And this is what we need to understand. The next things I want to add from the other side, which is this zone right here was a smart money trap. I'll show you why. Why was this zone a smart money trap? Well, first of all, we can see very clearly the liquidity where we have 3 touches here, another touch here. And when we actually zoom into this area, we can see it's a nice accumulation where we had selling climax, secondary test, spring, bullish break of structure, and then inducement, push out. So this is an area that smart money traders will be looking at, but when price comes back to this area, it gets induced. It gets induced by just a few pips. So we need to factor that in. Now, it's not to say that I took a loss, I'll take a win, or I'm better than smart money traders. That's not important. Although smart money traps is something we utilize, we will not take losses where smart money traders take losses. We are better than this. But it's also important to note that whether I took a loss here or not, I may have, I may not have, probably not. But let's say we did. It does not matter because we are looking at the zone of manipulation and utilizing it to our advantage. This is not me versus smart money concepts. It doesn't matter. What I'm saying is notice when smart money traders are getting taken out, and that sense is of control. So when I start to see that a smart money zone got induced by just a few pips, 1 or 2 pips, and then started to go higher like the smart money traders wanted, that's clearly a manipulation because price went up in a smart money zone without the smart money traders. It took their stop losses first. That is a sign of an inducement. That's a sign of real control. So now we can see that the buyers are in control. So when I turn on my personal indicator, my personal tool to see session timings for the daily cycle, I can start to build a thesis now that is going to be important for me to reflect on who is in control and what decisions to take. So before we get into our Asia range micro read, there's a few things to understand. Number one is that we have this demand area right here. Now this demand area right here, it is only important because it's an extension of this previous inducement. Price is tapping here with another inducement that led to this bullish price action. However, this could all just be the bullish complex pullback as part of this lower high, lower low, lower high, lower low, price going lower. So I want to be careful not to be buying on this demand area if that is the objective, because the sellers from these supply zones could be in control. Remember, this is an inducement lower high that made the lower low. So I'm locked, and I need to understand that I have supply zones, yes. I have demand zones, yes, but I have them on both sides. Who's really in control? Inducements will tell me. So before we go into the full read, what's the liquidity? What is a very clear liquidity? Well, first of all, we have price over here that has done an inducement. We're going to put liquidity and inducement high and label this out. That is an inducement high. Now, why am I interested in this area is because number one, it's in a inducement supply zone. That whole trend line that we had on the left, all of that trend line was taken out by who? It was taken out by these inducements, bearish break of structure, mitigation, lower low. So price has come back to an inducement supply that is structurally relevant and inducement relevant. Price has come in and tapped into that zone, given an inducement and gone on to make a low. Perfect. But more importantly, And the key is the divergence between GU and EU. In EU, this was making a high into the supply zone and then a lower high. It was looking something like this. Whereas in GU, the one we're looking at, price made a higher high to this wick. So if price has gone higher on one and lower on the other, that temporarily depegging between a correlated asset, that is a sign of manipulation. So this confirms to me that this is the inducement of control, because it's in an inducement supply and there's a divergence and inducement within here that led to a lower low. Clean. This is something I need to pay attention to. Now, when I see the reaction afterwards, I can start to see, yes, the sellers are in control, but we had this inducement of a smart money trap. So now I'm in between zones again. I have a supply zone inducement. Sellers are in control. I have an inducement of a smart money trap. Buyers in control. Once again, the tug of war is playing. I need to determine who's in control, because up until now, I do not have full clarity. Then I mark out obvious liquidity. And for me, this is screaming obvious liquidity. When you have a very obvious trend line that has 1 touch, 2 touch, 3 touch, and price is getting in over here. We're getting to our Frankfurt open. We are ending Asia range. What is price doing? Internal lower high, internal lower low, internal lower high, internal lower low. Price is inviting sellers to get in here based on the trend line, based on internal price action, probably based on EMAs, and even the perfect golden pocket of the Fibonacci level right here. You don't want to pull it from this one, you pull it from here, still perfect Fibonacci. So when you have these Fibonacci levels, you have trend line, you have lower time frame price action, you have the session open of Frankfurt, people are getting in. So I'm going to factor this in. And this is how you start to build a thesis of control and traps. So let's do this properly through Asia. So let's do a full read from the top. So we had that supply zone inducement. That was a divergence between EU and GU. That's leading the show. Inducement number 1. We have mitigation and then mitigations. Everything up into here is fine. Now when I start to focus on the next area, well, we can see build up, inducement, run of liquidity, bearish market, mitigation. Sellers are clearly in control, a full liquidity cycle. This is the fuel that allows price to come lower and take out this smart money zone. Why is that a smart money zone? We look left and we remind ourselves that this was a very clear smart money zone because we had perfect equal lows with 3 touches, a sweep of liquidity and bullish price action. Price came into that zone and said, no, thank you. So when I see this, I start to see the sellers were in control, but they're in control simply to induce, and then the buyers to control. How can I see the buyers to control? Not just because price went higher. That's not enough. We also have to see equal lows, perfect, inducement, perfect, higher high. Who's in control? The buyers have gained control. And we start to see the domino effect, which is the main thing, because this is indicating me a sequence of control, and that is the narrative. So we've had an inducement of a smart money zone, inducement 1, a follow-through inducement, inducement number 2, and then price arriving to the seller zone. The previous inducement seller zone that I mentioned, price is arriving to that supply area. What is it doing? It's starting to give bearish price action. Lower high, lower low, lower high, lower low. Sellers are going to be getting into this area. Price flips on them. So that is showing me that this is an inducement because we enticed and invited in sellers. We swept the liquidity and we had an inducement high. Perfect sense of control once again. Amazing. So when we start to see this sequence of control with inducement 1 of a smart money trap, inducement 2, a minor inducement within Asia leading to a high, a supply zone flip with an inducement low to take out the supply zone, this is starting to tell me that the buyers are really in control. Now, when I start to see the session is opening, it's coming to my London open, this is where my decision making begins. So if I start to see that we have this previous inducement that I just covered is getting induced. We're getting an inducement high of that last supply area that made the lower low, that had a full liquidity cycle that I just mentioned on M1. That area is now being taken out. We're getting this higher high here. We are also seeing this whole inducement supply zone that had the divergence and also had an inducement within it that made this low. This area that I like, what is happening? We have this imbalance right here on M5. That imbalance defines my supply zone from inducement to imbalance. That is my supply zone. And I want to see price arriving into that area as a mitigation before I take any trade. But for now, I can see that this trend line has been taken out, liquidity. Asia high has been taken out, liquidity. Previous inducement zone being taken out. This is a sign that buyers are in control and we've grabbed liquidity. Maybe we are chasing this supply zone to mitigate. So that's what I'm going to focus on now before I take any decision. Now, the reason I can't just jump into a sell, because even though we've taken Asia high, we've had a sweep, is because buyers are in control. Inducement 1, inducement 2, inducement 3. I cannot take a sell until I see sellers are in control based on time-based manipulation. So I need to see price arrive into the supply zone and also do inducements. So when I see price is doing something like this, price is now tapped into the imbalance, closed off the supply zone, induced the areas on the left, induced Asia high, and we're arriving to London open, which is this gray box based on my indicator. When I see all of this playing, I'm thinking this is great. This is signs that sellers could take control, but they are not in control. So I need to clarify that. So when I start to see a reaction and I start to see something like this is where my interest is getting into the market. This is where I start to see perfect. We have equal lows and we have a minor inducement over here, a minor inducement of that high into my supply zone. The only reason price needed to come here was to tap into that supply zone, close off the imbalance. And then we start to get an internal mitigation and a push down to form equal lows. Price, as we know, is magnetized towards liquidity pools. That there can be a perfect liquidity pool for us. So this, when I see these equal lows printed, is when I can start to take a decision and say, okay, this is worth a shot. Now, the reason I can say it's worth a shot is because we have inducement in control now. So if I'm to take a trade based on that imbalance right there, putting my stop loss at the high of the day and then sell. Why is this an okay trade? Why is this a sensible trade? Well, ideally, I'd want the break of structure. That is golden. That is our preferred lower time frame confirmation. Number 2 is our 2-leg protocol. There's various other lower time frame confirmations, but an inducement into supply on a time window, leaving equal lows, is a strong lower time frame model. Not the preferred one, but we can see that this could tap into it on London Open 8 a.m. UK time on the minute. That would be wonderful because as we know, a liquidity cycle is simply build up, inducement, mitigation, equal lows, tap and go. And if that tap and go happens on a time window, that's time-based manipulation. And we can start to see that price is going to overpower these kind of reverse inducement, the inducement lows that are going to be counter our thesis. So when we are combining everything, we've got an inducement supply that had a divergence, check. We had an inducement of Asia high, check. We had an inducement of a previous supply zone, check. Remember this one, that was a liquidity cycle with the build-up, inducement, mitigation. This whole area got taken out. We're closing off an imbalance and we're getting time-based manipulation, a minor inducement with a equal lows, lower time frame model on a London Open. And where can we see price at least go? Well, worst case scenario, if the price is bullish, price went up, price will go back to our previous inducement zone and continue higher. By then, we could have already taken partial. We could already be out the trade. We could already be break even. So it's still worth a shot because we play the intra-session risk-reward game. As we know, on average, EU and GU move on average 15, 20 pips during a London session. So for us to get 15 to 20 pips with a 4 pip stop loss, we can very easily get our 1 to 3 risk-reward within 12 pips. So if we can get our 1 to 3 risk-reward within 12 pips, which is TP1, well, that's average session volatility. And that's actually aligning exactly with this demand area. So worst case scenario, if market reverses on us because the sellers are not in control, we get the reaction, we get our 1 to 3, and the rest can be a break even. So this is fine. This is why I trade aggressive reactions. And even though the market is in a higher time frame demand area, it still makes sense to sell because the sellers are in control. Because I can see it from time-based manipulation, I can see it from the supply zone. Everything is telling me that it's worth a shot. Not a prime setup, not the best of setups, but this is intelligent trading because you're not using market structure, you're not using smart money concepts, you're using time-based manipulation, liquidity, and M1 trading to confirm the sensible zone and the sensible reaction. So right here, price is tapping into my entry and pretty quickly we get a reaction. London Open on the minute. What is it doing? It's closing off this imbalance right here of that zone and this should be ready to go. So when price is doing something like this, it's chopping around. It's tapping but it's not immediately going. So the reason I'm not panicking and not jumping out of this trade is because if I'm speculating that this is the inducement of the day because we tapped into a supply, an inducement supply had a lower time frame liquidity cycle on the time window that is now having bearish price action like so. This is the lower low. This could be the lower high. We could go on to make a lower low. The reason I'm not jumping out is because we have been protected by this bearish price action, but on the same time, we are getting bullish price action over here. This divergence is showing me that this is a manipulation and therefore the sellers are actually still in control because we're going lower on GU but higher on EU. Temporary depeg, a sign of manipulation, and therefore it gives me confidence to still hold my trade. So I hold on to my trade and I have to remember and remind myself that the 1 to 3 target is right here, right within that 12 pip of this counter demand area. So I'm going to be taking partials out of 1 to 3 right here. So we allow price to flow because we've had high, internal lower low, internal lower high, potentially going on to make that internal lower low. And we can start to see it's following a rhythm and it's following a flow where we have mitigation of this refined IFC tapped in. This refined IFC in imbalance tapped in with this wick. This same imbalance tapped in with this wick. This is order flow. We have inducement, mitigation, 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 and mitigation. Order flow is a sense of control. And although price is tapped into this demand area, the previous counter demand area is not showing me control because we're tapping into this supply zone. The previous supply zone is getting mitigated like this. And once that previous supply zone is getting mitigated, we are getting bearish rejection from it, showing me that the buyers are not in control. Therefore, it's still worthwhile holding the trade. And this is exactly how we'll continue to look at the market, to sense control, because although price is coming into this demand area now of this inducement zone, I need to sense control. And right now we are throwing wicks, 1, 2, 3, 4, 5 wicks, and we are starting to get a reaction. But if price respects this level, then well, buyers are not really in control, and we can start to see that we are going to this between zones. And once again, same thing as before, we are in between a supply and demand area. Inducements lead the show. So we need to see that inducement to get the idea of control. And how do we sense who's in control? Well, this area right here was the inducement. Price induced high into this supply zone, like so. That becomes the inducement of this supply zone. And then price starts to mitigate and hold that level. So this inducement follows on from these consecutive inducements. It can also be a potential inducement of this trend line that was forming, very clear, where we had 1 touch, 2 touch, 3 touch, 4 touch. Excuse the mess on the drawings, but you're getting the idea. So we start to see that the sellers are actually in control, not the buyers, because even though we're in an inducement demand, this inducement supply zone with the liquidity cycle on time is actually holding control. And then we see prices breaking through that again, breaking through this demand area. Why? Not randomly. It's because the sellers' inducements are leading the show. And that's exactly how you allow price to keep flowing towards your take profit level. And that's how you do intra-session, intraday trading. Next target naturally has to be Asia low. So until Asia low, the next liquidity pool is taken, you don't take an action. You allow price to breathe and you follow the show of inducements to see who's in control. We follow this show to say, okay, if we're doing a build-up, inducement, and internal mitigation and pushing lower, sellers are in control. Now we're getting a reaction over here. We need to go investigate and say, well, that's not random. That's the last inducement we mentioned. Price is tapping in pip perfect to the last inducement zone. Temporary demand, inviting buyers in, but they shouldn't hold. No surprise. Price consolidating. New York open. There we go. Price continues lower. Now into our M15 demand area that we marked out earlier over here, the inducement demand. So you can see price pings from inducement zone to inducement zone. It's not a coincidence. If you're not reading inducements, you're trading blind. If you're not reading M1 inducements, you are trading blind, because all these reactions are happening from these inducement zones. Same for this one. Right now we can see that the sellers are in control. Price creeps towards our take profit level and we allow price to do its thing. Perfect trading. So this is just a case study. It's not the perfect trade, but in a scenario where you have buyers and sellers locked, market structure locked, lower time frame will reveal everything. Inducements on time will reveal everything, and inducements are king to show you who's in control. This is how you need to be trading. And remember, a restricted trader is a profitable trader. Follow that mantra, because then that will not make you mess things up.